Welcome to Thoughts on the Market. I'm Michael Zezas, Head of Public Policy Research and Municipal Strategy for Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, I'll be talking about the intersection between U.S. public policy and financial markets. It's Wednesday, May 13th at 11 a.m. in New York. After a quiet few months for the U.S.-China trade relationship, it's now reemerging as a key variable in the outlook for the global economy and markets. It was only a few months ago that the two countries inked a Phase 1 trade agreement. And while there were many question marks around the sustainability of that deal, many observers felt there would be a long détente before the deal was challenged. But the advent of COVID-19 upset this dynamic and now poses a substantial challenge to the fragile peace. For investors, the question is whether the Phase 1 deal can stand, or will the US and China return to a cycle of escalating tariffs that would threaten the prospects of a rebound in economic growth. First, let's understand why this is happening, and it's a mix of political and practical factors. On the practical side, the economic impacts of COVID-19 pose an operational challenge to the Phase 1 agreement. To hold up its end of the deal, China was to increase imports from the US substantially. But with its economy impaired earlier this year, China fell behind the pace, and the US will now have to decide if that's an acceptable excuse. On the political side, there's increasing incentive for the US administration to claim China didn't sufficiently respond to COVID-19 in its early days. Recent polls suggest voters are increasingly willing to blame the president for COVID-19 impacts, but are also willing to blame China. So it's not surprising that the US administration has publicly floated the idea of using economic tools to sanction China. China rejects this premise and is openly mused about the need to restructure the trade deal. So we think it's fair to say that tensions are elevated and will likely stay that way through the US election. The good news is that polls show voters also care a lot about the economy. So in our view, watch for both countries to trade more non-tariff actions, such as the US instruction to its federal pension fund to divest from China stocks, and the writing of tighter export restriction rules. Hence, the tensions stay high, but the actions stay short of returning us to the dynamic in 2018 that brought us close to recession, tariffs weakening corporate confidence, and consequently, global spending. One last word of caution though, the US-China dynamic is ever evolving, so we must monitor vigilantly. Thanks for listening. For more video from Morgan Stanley, please subscribe here to our YouTube channel, or you can subscribe to Thoughts on the Market directly on Apple Podcasts or your favorite podcast platform.
The preceding content is informational only and based on information available when created. It is not an offer or a solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.